Okay, great stuff. So, part two. So, really, let's talk about this, the financial liabilities, the idea of how we recognize, if you like, loans. So, it says initial recognition of financial liabilities. At initial recognition, an entity shall measure financial liability sorry, that should be at its fair value. And so this is often the net proceeds being the cash received less any issue costs associated with issuing the um, liability. And then after recognition, the entity shall classify all financial liabilities. Well, if all financial liabilities at amortized cost. So this is typically what we know of. Sorry, I was just sort of. So let me just kind of break this down a little. I was looking for a clean point there. Let me just kind of maybe simplify this before I just kind of expand this. So really, let's talk about this. Typically, right, if I came to you and I said, lend me £1,000 now, and I'll start off with a simple scenario and just say I'll give you back in 1 year. And I said to you, and I'll give you back £1,100 in a year's time. Well, before you did this, at least what you would do is you would Google bank and see how much, if you had actually deposited your £1,000 in the bank, how much the bank would have given you. So you at least the only reason you'd give me the money, I mean, we're not friends, it's just a straight business relationship. You'd give me this money is because the bank is offering you less than, because the bank is even more secure and taking all those risks into consideration. Let's just assume if the bank was offering you 10% as well, you'd probably leave it in the bank. You probably won't give it to me because at least you're sure you're going to get it in the bank. If the bank was giving you more, 11%, you definitely won't give it to me. If the bank was giving you 9%, you can see I'm creating a dilemma for you because yes, you're getting less in the bank, more from me, but there is a greater chance you'll actually get your money from the bank. But anyway, key point here is that your reference point will be the bank or a market. And I'll just come back to that. So now I've moved away from the bank and said market. So you look at the market. So you could lend your money, put your money in the, if you go into financial markets, you could lend your money to Tesco's, to Asda, and see what they're giving you, if you like. But the point is that with all these relationships, there's always a figure at the beginning and a figure at the end, if you like. So so we could extend this idea. We could argue that, listen, I could have said to you, give me £1,000 now, and I will give you, after 3 years, 1,300 or something along those lines, right? And in exactly the same way, you would have a reference point. So, and I'm just grading this. I'm just saying, you just give me a straight £1,000 and I will give you 1,300. I won't give you anything over the 3 year period. I'll just give you your 1,300 at the end of the 3 year period. So again, like I say, you would reference looking at a bank and sort of imagine, okay, if I put £1,000 in the bank now, I would, at some interest, I would get this after the first year if I left it. So imagine that's my principal. Left it again, I'd have some more, and left it again. What would be the closing figure if I'd left it in the bank? And imagine it was, whatever. Imagine it was more, you wouldn't give me the money. If it was less, you'd probably give me the money. So my point is that what at least, if you like, what we agree or accept is that you would have to be indifferent, or the figure, the rate, we have to assume that the only reason you're going to give me this money is that it's because it's equal to the bank rate. Let's just say it's at least the bank rate. And therefore, this is the relationship we associate between, if you like, the principal and the end. So really, the first point is that this relationship, someone says, you know what, give me £1,000 now and I'll give you 1,300 in a period of time, is fine. But what, in terms of recognizing this, so imagine, it doesn't matter who we talk about. Let's talk about me. I borrow £1,000 from you now, so I've got £1,000 in the bank, and I have, if you like, here this £1,000. So really, I know that over a 3 year period, I have to recognize, if you like, interest and interest cost, right? Because that is, I have to literally, I'm just going to assume it's 10%. It doesn't really matter. So that's £100 of interest being, if you like, growing on the loan every single year. I mean, it is now 10% on the 1,100 when I get here, but I'm just going to keep it simple and just say, imagine it was just I'm just whatever. That's okay. Say well. No, let's do it correctly. 1,110, and let's just say 1,120. Sorry, no, 110 and 120. And after 3 years, I have my final closing amount, and I pay you your money. So I debit the liability and credit bank. So basically, interest would have grown over 3 years on this loan. And this interest that we're really talking about here is what's referred to as the effective interest rate. I mean, it's the actual cost of you lending money to me, right? Because you wouldn't lend me money if you weren't going to make something on top of it, ultimately. That's the first point I wanted to highlight. This is key vocabulary, this idea of the effective interest rate. I mean, this could be the relationship we have, where you literally give me £1,000 now and I give you £1,000 300 in the future. But we could have a different relationship. We could have the relationship that says, you know what, Owen, you give me, I'll say to you, listen, give me £1,000 now. And what I'll do is every year, I will pay you back at least every year. So at the end of every year, I'll pay you back up. I mean, it doesn't really matter. I'll say I'll pay you back £50 every year. And of course, and then I'll pay you back your money as well. So, if you like, I could have something along these lines. Or I could say I'll pay you. Or I could say I'll pay you £50 every year. Sorry, and pay you back your money. Or I could say I'll pay you £50 every year, and then I'll pay you 1,200 at the end. It really doesn't matter. My point is that you and I come to an agreement, in effect, of what it is that we're going to deal with. Here, give me this, and I'll pay you back this. Whatever it is, the key point here is that we can always work out, based on tables, what that effective interest rate is, because I can sort of say, I can work it out. Now, my point is, the secondary point I also want to make is that this relationship, if I look at the present value of these figures, they will always be equal to the present value. The present value of all of these figures will always be equal to 1,000, because this is the only condition you will lend me this money. You're never going to lend me money, if you like, with you making when I say you making a loss, if it's not as good as the bank rate, which is this effective interest rate that I'm calculating, you're not going to lend me the money, right? You're only going to ever lend me the money if it's at least equal to the bank rate. And I like to call the bank rate the effective interest rate. So I could say, you know what, I'll pay you this. I'll pay you 50 every month, every year, at the end of every year. So I'll say sort of, that's, if you like, 5% on this 10,000. So this 5% is this 50. This is a cash payment. It's not the effective rate. It's just a cash payment. I'll pay you this and then I'll pay you your money plus a premium, or I might just pay you your flat money at par. What relationship are we having? So you just look at the question and actually look at the relationship, in effect. Now, for us, they're giving us the effective interest rate, which is wonderful. So in effect, all I'll do is I'll start with my 10,000, and I will basically always apply the effective interest rate, of course, and then every year take off whatever it is you're paying me to reduce this principal, and then apply the effective interest rate again, and you will see that by the end of the period, you actually arrive at the amount that you finally owe. So you can see that really and truly what's happening is that we know what we start with at the beginning. We know what we're going to be paying at the end. We know what the intermittent payments will be, and then we kind of from there work out what therefore the effective cost of capital or the effective interest you're receiving for lending me this money actually is. So it's kind of worked backwards. Of course, the effective interest rate will be more if you chose not to pay anything and you just chose to pay the 1,300. Of course, it'll be more because I'm keeping the money for longer without paying anything towards it, right? It's like having a loan where you don't pay anything to reduce the principal. So the effective interest rate will always be on the whole amount, like a credit card that says don't just pay the minimum amount. You can pay more, because in the long run you're going to be paying more interest on the amount you've borrowed for the longer you're holding it. So I thought I'd just say that. And I think the final thing I want to say is that really, initially what used to happen, like I said here, is that someone could say, listen, I'll pay the interest, if you like. So if I borrow £1,000 and someone says, listen, I'll pay you, if the interest is if someone says, listen, I'll pay you 10% on this every single year, 10% on this every single year, and I'll pay you back your money at par of the amount you borrowed. Now, that's fine. You can have a loan like that where I've lent you money and I'm expecting, and the agreement is this is the market rate is rate 10%, and that's kind of the effective interest rate as well. So we're sort of saying, yeah, that makes sense. 10% is what the bank would have given me. You're willing to give that to me as well. So what would literally happen is I would accrue, of course, my £100 on that. I'm expecting 100. You pay me 100. So at the next year I have 1,000 again, of course, that you owe me. You interest accrues of 10% throughout the year. You pay me if you like. So you can see the cash payment of 10% on the paper, on the 1,000, is exactly equal to the interest that I'm expecting. And at the end of the period, I do that again in the third year, and at the period I pay. But again, like I say, it's possible that you don't have anything here. It's possible to have said, listen, I won't pay you anything over 3 years. So think of that as a 0% coupon. This is 10% coupon, and this, when I say coupon, coupon just means cash payment on the actual amount, and then but interest will accrue, and that's given to us. So it's that relationship that we're constantly balancing to recognize this over the life of the loan, because we must always, if you like, accrue interest. We cannot say, listen, yes, I received £1,000. I'm not going to do anything now until I finally pay in 3 years. No, interest must accrue in the same manner a bank would accrue interest, but it might be interjected by payments, therefore reducing the effective interest. So every time someone pays some money towards that loan, they're reducing effectively the interest over the period of time. So great stuff. So in the next video, we'll start to sort of see how this materializes.